Good afternoon, and welcome to the Energy Perspectives Group webinar, hosted by American Resources Corporation. This event will be recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask the speaker, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
All right, welcome everybody. Glad you guys could make it. Today, our host company is American Resource Corporation. It is primarily a producer of metallurgical carbon, or met coal. This is not the kind of coal you burn. It is used primarily as a source of carbon in making steel. The company's operations are based in Central Appalachian Basin in Eastern Kentucky and Southern West Virginia. Our speaker today is Mark Jensen. He's the CEO and chairman of the board. He founded American Resources 5 years ago, and it went public in February of 2017. Since 2006, he's been working in the industry, and he's been instrumental in all aspects of acquiring, restructuring, and building mining operations. He's been able to work with his team to significantly expand the company's asset base through strategic acquisitions and organic growth in a very accretive manner. He's a graduate of the Kelley School of Business at Indiana University with bachelor's degrees in finance and international studies. So Mark, it's all yours.
Dan, I appreciate the introduction, and thank you everyone for joining. I'm excited to tell you a little bit about what we're doing in American Resources Corporation, a company that the management team not only founded, but we're also the majority funder of the business. So we are the largest investor in the business to date. And we're really excited about how we're disrupting this industry to provide raw materials to the infrastructure market. Throughout the presentation, I may reference forward-looking statements, so please refer to our SEC filings should you have any additional questions or need additional clarity on any statements that we do make. As stated, American Resources Corporation we believe, is a really exciting business, and what we're doing is we're providing raw materials and the high quality raw materials to anything infrastructure. So think anything that steel is made of, not only here domestically in the United States, but also in the international market. So with the primary driver of where we've been selling product is the Indian, Turkish, and Croatian market, but also here domestically, as you hear about all these various infrastructure projects taking place throughout the country, either at the state level, city level, as well as the federal level. I want to be very clear about what we produce. So our primary market is metallurgical carbon. It's the actual carbon value that you extract in coal. And what that is it's blended with iron ore to create steel. When you hear about coal, a lot of people talk about the broader markets, which is thermal coal, which you burn for energy generation, which competes against natural gas. Natural gas is winning that war. And that's a market that since inception, we have stayed away from, and it's never been a focus or driver for our business. We've always focused on where we see the growing market, which is infrastructure. A little bit about our business and where we operate. So today we have 3 active sites that we're getting ready to turn back on coming out of COVID. We own a portfolio of over 24 near-term projects that we can bring back online. And what these businesses are, they're assets that we've acquired over the years from large global players, multi-billion-dollar companies that have traded on the public markets, that we've been able to be nimble and focused on in acquiring either through 363 bankruptcy sales or strategic acquisitions. Our business is focused on meeting that global demand. So as the steel industry starts to and continues to ramp back up coming out of COVID, as well as just for broader infrastructure related projects, we can meet their demand and scale with their demand effectively, rapidly, using minimal capital expenditures. And why we were able to do that is because of what we've done over the past 5 years. We've invested our own capital in the business first before we asked any investor to do so, to build a very cost-effective business model that can scale revenue growth and scale margins rapidly and survive during any market downturn. And really that's when we've thrived. We've grown our business dramatically during the challenging periods of time, no different than what we've done during COVID, and we'll talk a little bit about that here shortly. The unique thing about our business, and because that capital we spend, is we're highly scalable. So you'll see in the coming years, next year, the year after that, we'll be able to scale our revenue and our cash flows very efficiently and very effectively. We'll dive into how we're going to do that and what the metrics are that will enable us to do that throughout this presentation. Briefly, the corporate structure of our business. We have two divisions today. We have our carbon processing, production and processing business line, which is where we mine, process, and ship metallurgical carbon throughout the world. We also, during COVID, have launched our American Metals business line, where we're not only producing met carbon that goes into new steel production, but now we're also providing the raw materials that go into the electric arc furnace market, where you're recycling used steel to make new steel. And through that, it's not just steel, but we also extract all those other high value metals out of products that we're recycling and ship those off to various customers as well. As stated earlier, and we just always want to make this extremely clear, when you hear about infrastructure, that's what we do. We provide the met carbon that goes into the steel making process. So what you do is you take the met carbon, the met coal that we produce, you heat it up and you molten it and blend it with iron ore, and through that process, steel's created. What the carbon value and what's unique about the carbon value is it's the strength factor that creates steel. It's what makes steel strong. And that's why where we produce our met carbon, met carbon from is really unique. And we'll talk a little bit further about that throughout the presentation here. Our business model is very different than what you hear about in the industry. We view ourselves as a disruptor to an old legacy industry. And how we disrupt it is just using modern fundamental business practices. We think smaller, we think more efficient, we think more nimble. And what we do is we go out there and we identify these high value met carbon deposits, and we either acquire them through 363 bankruptcy sales or these strategic acquisitions. And then what we do, if it's going through the bankruptcy process, we restructure those assets to be extremely efficient and extremely cost-effective operations going forward for the next 5, 10, 15, 20 years. We've closed on over 8 acquisitions in the last 5 years, and 5 of those have been through 363 bankruptcy sales. It's a structure that we're well versed in, and it gives us that ability to really streamline the operations and cut costs dramatically, which I'll walk through also further in this slide deck. A little bit about our acquisitions that we've closed. Here's some some of the larger components that we've acquired. We bought McCoy Elkhorn, which had over $170 million invested into it. We believe that the asset value is closer to $145 million today. This was a subsidiary of James River Coal, which was a $2 billion public enterprise value business. A great facility, state-of-the-art. We bought ICG Knott County from Arch Coal, which was formerly ICG, which was built by Wilbur Ross. He sold this ICG to Arch Coal for $4.2 billion. They allocated over $400 million to the Knott County division. Obviously, we carry it at much more conservative fundamental asset values today, and we think it's asset value-wise, we have a lot of room to appreciate in our public currency, but more importantly, the revenue and cash flow that we're going to drive off those assets for the next 5 years is what's going to be important and what we talk about here. A little bit about our playbook. The McCoy Elkhorn acquisition, which was one of those assets that had over $170 million invested into it by James River. We acquired this in February of 2016. We shut down all the thermal coal related assets from this and really focused on centering in and honing in the metallurgical operations. This subsidiary of ours, this division of ours, we're looking at bringing back online in the second quarter of next year, and really driving the met coal production where we can ramp this up to over $120 million in revenue by the end of next year, just from this one division alone. Our overall business, you can see our corporate structure. All of our subsidiaries are 100% owned by the public company. So we don't have any minority investments in any industry. We don't have to rely on any third parties to extract the product. We don't have to rely on any third parties to process it. And we can load it on either the CSX or the NS from our own rail load out facilities. So we own the entire logistical process to get our product to market, either through the Gulf of Mexico, the East Coast ports, or shipped here domestically, or up even through the Great Lakes. Another slide that just drives it home. What separates us from a lot of our peers is that we don't produce thermal coal. So as you see thermal coal pricing and pressure really getting affected nowadays, and even pre-COVID, you saw it having a lot of pressure, our competitors are struggling because of that, because they're trying to grasp to that old legacy industry that's really dying on the vine today. Where we focus on is the infrastructure side, which is the high growth component of it, where you're seeing demand coming out of India, which we'll show you the slide and proofs in the pudding of what they're doing over there. They're building out massive infrastructure projects. That's where we see the growth with our industry. It's been a smaller component of our industry, but we're going to grab huge market share, and we're also going to be able to grab that market, that additional demand that's coming online that we see in the very near future. Why our assets are unique. If you look at the high value met carbon in the world today, it comes out of really two locations, either the United States or Australia. Within the United States, Eastern Kentucky and West Virginia, which is where our complexes are based at, are the highest quality of met coal you can find in this country. The only other place really in the country you can find it on any meaningful scale is in Alabama, which is 100% unionized. A unique thing about our business is we have no pension liabilities. We have no past legal liabilities. We have no union liabilities. We've never been a union operation. So we're set up to be a lean operation that can reinvest our cash flow back into our operations to continue to grow the business and not have to worry about these past liabilities that all these bigger companies that have tried to restructure but haven't been able to do so effectively. They're going to be worried about that. We're going to be worried about growth. Talks a little bit more about it. Our headquarters is in Fishers, Indiana. I live in Fishers about half the time. I'm down in Eastern Kentucky, West Virginia about half the time, about a 4-hour drive to all of our operations. All of our operations are within an hour and a half of each other, so we can run a really lean corporate overhead structure. And we've done a great job of minimizing that through the acquisition process. We've eliminated about 85% of our corporate costs as a business by just centralizing all of our functions, centralizing our accounting, centralizing our purchasing, to be able to, instead of paying people to do things in a redundant manner, we can drive cash flow to our bottom lines for our investors so that we can grow our business and grow our earnings per share while also growing our price per share for all of our investors. From the demand side, so we own the assets, which is, I think we own a state-of-the-art fleet of assets with an appraised value of over $370 million, almost 10 times our market cap today. We have the people, we have the resources, we have the structure. We've restructured it. We spent the money over the last 5 years to build out an asset base to scale up and meet the demands of our customers. The last component of building our business and really driving the value of our business forward over the next 5 years is the demand side. And we've never felt better about where the demand's at. And today you're hearing massive amount of infrastructure projects being announced on a daily basis, including over in India. They've passed a $1.7 trillion infrastructure bill 2 to 3 years ago. They just passed another $300 billion infrastructure bill today. To put that in context, their forecast, McKinsey and S&P, which are two large consulting companies that do a very good job of what they do, are forecasting that India's incremental demand on a yearly basis is going to increase to 84 million tons, scaling up to 84 million tons annually a year. To put that in perspective, the entire United States exported 66 million tons of metric coal the year before COVID. So they're forecasting on increasing their demands by over 130% above what the entire United States can supply today. That's going to be a huge driver for future growth. We've established our distribution lines to get product to India very cost effectively for us in a way that doesn't squeeze our cash flow and enables us to continue to grow with India's demand. And we'll be a large supplier of them for many years to come. We're highly confident. But even looking at the broader context, the demand for metallurgical carbon and steel and infrastructure has never been bigger. And more importantly, it's never been more needed. As you see alternative energy come online, as you see oil and gas continue to drive value, the pipelines that they build, the distribution facilities they build are massive drivers of steel. As you see projects and roadways be developed, and even here domestically, bridges, tunnels, roadways, the amount of infrastructure we need to spend domestically is huge. In third world nations, in the China, the India, the Africas of the world, as they build out infrastructure, that's huge steel demand that we're going to continue to be able to supply and we're going to continue to be able to grow with. Here domestically, people always ask, what happens if Trump loses the election, or what happens if Biden wins the election? We're agnostic. I mean, from a business perspective, we're set up to scale our business regardless of who wins the political elections. Why? It's because both parties want to build infrastructure. Both parties know that we need to build infrastructure here domestically. Trump wants to pass a $1 trillion bill. Biden's talking about a $2 trillion bill. Regardless of the party that wins, we're going to spend money here domestically, and we're already seeing it. And importantly, if they pass a federally funded infrastructure bill, who's going to win? The United States steel industry is. Why? Because any federally funded infrastructure bills have to be built using US-based steel. There's a law put in place to do that, which means they have to use US-based metallurgical carbon. That's going to be huge drivers of our demand, which is going to not only drive revenue growth for us, but it's also going to drive margins, because prices are going to have to continue to appreciate, which we're going to be the beneficiary of that, launching our operations here in the very near future, which I'll talk about here shortly. This talks a little bit about, you can just see the infrastructure and the number of projects that they're talking about. You can read about it daily. Just Google infrastructure projects and you'll hear about it, projects being announced on a daily basis today. We've set up the distribution channels, as I mentioned earlier. We can get our product to any place in the world very cost effectively, given our rail loadout facilities that we access at our properties. The rail access that we own at our properties today, which means we have an efficient way to get product to market through our existing logistics structure. Now it's just about ramping up our operations, which we're getting ready to do here very shortly. As we ramp up our operations, as we bring our Perry County operation online here in the fourth quarter, Perry County will be the first mine we bring back online coming out of COVID. We idled down during COVID for a very specific reason. If we're going to extract product and we're going to process product, we want to make sure we're making great money on it. And we had a corporate structure that enabled us to do that. And not only that, we've been able to make our business better during this. We've been able to reduce our cost structure further during COVID by focusing on the fundamentals and focusing on the efficiencies and preparing to re-ramp up coming out of COVID in a very cost-effective way. We operate our businesses at the lowest quartile of cost structure in the industry. And why we do that and how we do that is we have no corporate overhead, we have no redundancy, we have very minimal debt on our books. It's all very friendly from a cap structure perspective. And we're a public company. We've used equity currency and we've used our own capital to grow our business. And that's a really unique thing, very seldom done in our industry. More importantly, because of the capital we spent in the last 5 years, we're able to ramp up our operations quickly. As I mentioned, we're ramping up our Perry County complex here in the fourth quarter. That mine, we're projecting to produce 1 million tons a year during 2021. That, to put it in context, and we've said this publicly, that translates to around $70 to $75 million of revenue with about a 28% EBITDA margin. We will then start ramping up in the second quarter of next year our McCoy Elkhorn complex, which we can scale up to around 120 million of revenue. This is not guidance, but we said it publicly and we're confident we can hit these numbers and we can scale up to these numbers over the course of the year as we continue to grow our revenue base. The beauty of our facilities are we can take the cash flow that our existing operations are running at and continue to ramp up to hit that 3 to 4 million tons of production a year in the next 3 years. Translate that to 2 to 300 million of revenue, and then the year after that continue to scale. We can effectively double our revenue every year for the next 5 years based on the assets that we own today. So we don't have to go out and close acquisitions. We don't have to go out there and continue to acquire assets to grow. We can utilize our existing assets that we've already restructured to scale our cash flows and our revenues rapidly over the next 3 years, next 4 years, next 5 years, and even further. One thing I'm super excited about, during COVID, a lot of businesses have struggled, and it's been a challenging time for everybody. I mean, we've had to change the way we do things. Everybody has. One thing we thought was extremely important is we're going to change the way we do things. Let's do them better. Let's not just try to survive. Let's try to make our business better during this period of time, and we've done that. We've done a phenomenal job of being nimble during the process, but more importantly, we've looked towards the future, and we saw the opportunity to scale our business by launching our American Metals business line. Utilizing our existing asset base that we already own today, we've been able to get into the recycled metal business and provide product to the largest electric arc furnace company in the world, Nucor. And by doing so, we've been able to aggregate and process used steel, segregate that steel, and strip out all the non-core components of it and ship that off to the Nucor facilities in a very cost-effective way and scale our business. We did $225,000 in revenue in the second quarter. We anticipate scaling that up to $2 to $3 million of revenue next year, and with the goal within 3 years to be at $20 million in revenue from the American Metals business line with around a 30 to 40% EBITDA margin. It'll represent about 10% of our business as a whole, but it's a business line that we can efficiently and effectively scale utilizing existing assets with effectively no CapEx. We can ship our product via truck, we can ship it on the rail, and very shortly we can ship it on the water when we acquire our barge facility, which we're actively working on today. One thing that you hear about in our industry, in the coal industry, in the carbon industry, is that environmentally, how do you do things? We're extremely proud of this. We've acquired over $48 million of reclamation liability through the acquisitions that we've built over the last 5 years. We've reduced that by over $24 million of reclamation liability in the last 5 years. So we've permanently reclaimed thermal coal mines that we're not going to operate on and reduce that liability and return the earth back to its original state. So that way we don't have that fixed holding cost of managing it. It's a key attribute to why we keep a low cost operating structure, and it's something we're really proud of. A little bit about our team. What's important you'll see here is that we come from a diverse background. So we're not stuck in our ways of doing things. We try to look efficiently and effectively about how we make each and every one of our decisions as we hit our 3-year game plan, our 2-year game plan, and our 1-year game plan. More importantly, everybody you see on the screen today is an investor in the company. We're investors first. management second. We think about the shareholders because we're aligned with the shareholders. We're not out there trying to collect fat cat salaries. We don't really care about it. We care more about the equity value of the company and what we're doing to increase that equity value on a daily basis. This slide talks a little bit about our asset base. I mean, it's something we're really proud of. If you go to our investor relations tab of our website, AmericanResourcesCorp.com, investor relations, you can click on a virtual tour and you can see what I'm outlining here in terms of a dollar value. These assets are state of the art. They were built by huge public companies that spent to the nines when they built it, and we've been the beneficiary of acquiring these through bankruptcies. We were nimble and we're really focused, no different than Wilbur Ross when he built ICG. He paid a couple $100 million, sold it for $4 billion later on because he bought assets when nobody else wanted them. That's what we did. More importantly, we bought the assets when nobody else wanted them, and then we restructured them and made them better. And we're really proud of what we have. We're really proud of what our assets can do and how we can continue to further drive revenue growth from the carbon side and the American metal side, utilizing this existing asset base. As I stated earlier, we're investors in the company for management. And that's something that I think speaks wonders to why we care so much about our cost structure and why we care about our revenue growth that we're getting ready to kick off here in the fourth quarter. Management today owns about 57% of the company. It's something that we don't want to issue stock. We don't want to dilute shareholders. We want to make sure that every dollar we bring into the door is accretive, because at the end of the day, we're sitting here as investors. That's where we have our money invested. And this is the shares that we own were mostly from capital invested into the business. And we're excited about that. We're excited about where we're going from a revenue base, and we think that'll translate to market cap here in the very near future. This slide is unique. So in the last 5 years, we've grown our revenue base without really focusing on it. Our focus has been about acquiring assets, positioning assets, establishing that hub and spoke model so that when we launch Perry County here in the fourth quarter, next year we'll be able to scale, the year after that we'll be able to scale, and the year after that we'll be able to scale because of the investment and because of the restructuring we've done over the last 5. Nonetheless, we did grow our revenue base. The only dip we ever had in revenue was in 2019. When we acquired one of our assets, we had one thermal coal contract left. We ran that facility until the contract ran out, and we didn't rebid on it. Why we didn't rebid on it? We were trading dollars. The revenue we're making had very low margin, and what we could do is take the infrastructure and the assets from that mine, and in 2021, we'll utilize those assets to bring one of our met mines online and drive that 20 to 28% margin versus 1 to 2% margin business that we had to fulfill for that contract. Going forward, all of our revenue will either be from metallurgical carbon or our American Metals business line. The milestones, and if you go back through our press releases, we try to be very transparent, and we're really excited about some of the news we have coming out here in the very near future. And those catalysts that we're talking about, and we've talked about publicly about bringing Perry County online. But if you go back through, you'll see some of the transformational decisions that we made. When we acquired Perry County, it was selling off a mine that was non-core to the business, that was losing money. It was the restructuring, the third-party processing agreements we signed to drive further revenue into the business. And we're excited about that. If you go back through, you'll see quite a bit of news on us, and you can follow the progression of our business, which we think is exciting, and we think it's going to be really exciting in the near future. In summary, I really thank all of you for joining. I think we've built a business that is highly scalable. It's not when are you going to generate revenue, it's we're going to generate revenue in the very near future. You're going to see, as we said publicly, in the fourth quarter, bringing Perry County online, that'll generate around $70 million in revenue for us next year with very good margins. McCoy Elkhorn shortly thereafter. We are positioned as a business where we can compete against any of our peers. From a cost structure perspective, is also from a scalability perspective. There's companies that produce that 3 to 4 million, 5, 6 million tons of met coal today, and they're trading at that $1 billion valuation. Obviously, we have to get the word out, and we have to tell people what we're doing, but we're confident we'll be able to do that. And with these mines coming back on, we're confident that our shareholders are going to be rewarded from the revenue and the cash flow that these assets are going to generate. We're excited to get the story out there, and we plan on being very transparent with our investors. We plan on doing a lot of communication here in the next few weeks and the next few months to continue to tell that story. And we really thank all of you for taking the time to listen to what we're doing. Hopefully it's appealing to you, and happy to answer any questions that you may have.
All right, Mark, I'm back on. You hear me?
Absolutely.
Okay. I just tell everybody, you should take your cursor down to the bottom of your screen and then click on the chat box, the chat icon thing, and it'll come up and you can type your questions in there. I'll start out. I have some questions that were emailed to me, and then I'll get to your questions. So, Mark, well, you mentioned the Perry County thing. Now, is that already up and running now, or that's next month or something?
It'll be here in the fourth quarter. So
Here
we've
in the fourth
already
quarter?
spent the
Okay.
majority of the capital to do that already. We finished restructuring it a little bit earlier this year. We've held off on ramping it up coming out of COVID, but we've got committed contracts for that business. We have the orders for next year, and now it's just about flipping it on here in the fourth quarter, which we anticipate will be hopefully on the earlier end.
Yeah. Okay. How many employees do you have?
So currently today we have about 60 employees. We'll scale up the Perry County complex to about 160. So we'll be about 180 to 190 total employees.
Oh, okay. But they're not union.
100% non-union. We'll
100%.
never operate a union facility.
Okay. And then, we've all heard the coal industry is on decline, result primarily in natural gas. I think we've shut down about 120 coal-fired power plants. It might get a little bit of an uptick here because natural gas prices are going up, and so coal might be competitive again on that. But, we know a lot of these coal-fired power plants have been shut down permanently. But how has that affected your business from the standpoint of all these thermal coal facilities are shutting down? Is that going to make less of this metallurgical coal available?
Well, it will from our competitors' perspective. So if you run it like where our competitors sit, and they produce maybe 50% met coal, 50% thermal coal, if their thermal coal business goes away, it's going to drive them right back into bankruptcy, and they're going to have to shut down.
Yeah, that's what I'm thinking. You're going to lose a lot of met coal supply, I would think, if these guys are shutting these things down. So
absolutely, and that's the competitive advantage that we have. Instead of diversifying, where most of our competitors do thermal coal and met coal, we do met coal and the metals business. So we diversified into the forward-looking economies. They're still hanging on and grasping onto the past. I mean, will thermal coal get a dead cat bounce? Maybe, but natural gas, the coal industry can't compete against natural gas, and it's never going to be able to. And honestly, I hate to prey on other people's businesses, but business is business. We're set up to succeed where our competitors are not, and we're going to continue to be able to grab a significant amount of market share. I mean, and really it comes down to supply and demand, right? As the demand is scaling, the supply is not going to be able to, so prices are going to even go up further, which we're not even forecasting yet.
Yeah, I saw a report the other day said demand for coal globally is going to continue to go up probably for another 4 or 5 years. It'll probably peak in 2025, and then it's going to roll over. But they're still building coal-fired power plants over in China and that. Now, like you mentioned India several times. Do they have domestic supply?
So on the metallurgical carbon side, I mean, and even on any sort of supply, they've struggled to ramp up their supply, but their met coal over there, their met carbon is of a very, very low grade. So they have to import from the Americas, and they have to import from Australia, which they prefer the United States because of our logistics. We don't have the antiquated ports like Australia does. And so they've been a huge driver of demand for the United States market, and it's going to continue to be. I mean, they're going to be the next whale in the space. And because the quality they produce is so low quality, they need to buy quality from us to blend with theirs to try to create steel out of it.
No, okay, I see. Yeah, you did mention also how the oil and gas industry uses a lot of steel. I think people underestimate that sometimes. You hear about long 2 and 3 mile long laterals, horizontal wells.
Mm-hmm.
They have to be piped all the way to the end. And it's got to be high strength steel, by the way. It can't be cheap stuff. So I'm sure it's got to have, and a lot of it comes from American steel mills. So.
Well, absolutely. Not only the natural gas industry, the oil industry, a huge driver of steel, the alternative energy industry too. I mean, most people don't think about the windmills or the distribution that facilities they have to set up for solar and all this stuff. I mean, it's immense drivers of steel, let alone, look at Flint, Michigan and their water issues up there. I mean, the amount of water pipelines that need to be built and built with high quality steel too. I mean, you can use plastic on some and PVC on some, but a lot of it's got to be steel. And I mean, there's a huge amount of money that's going to be spent here in the very near future in the United States on the steel industry.
Mm-hmm. Yeah, I don't. You mentioned Trump and Biden, whoever wins. That's one of the questions that you said. What effect does this have on your business? So are people in the well, I would think people in the coal industry would not be rooting for Biden.
They are not. I mean, my employees and the people in Eastern Kentucky are very big Trump supporters. I try to stay out of the political commentary because it really probably wouldn't benefit me. I mean, obviously, everybody's got their personal opinions, but
Yeah.
when we set the business up, we wanted to make sure we were agnostic, just because you try to reduce as many risks as you possibly can. So at the end of the day, we can focus on doing what we do well, which is scaling our revenues and our cash flows. And where we're sitting here today, I mean, from a business perspective, I can go to sleep every night knowing that regardless of the party that wins, they're going to be spending money on infrastructure.
Yeah. Hey, this morning I read your September 17th press release about recycling rail cars. Tell us about that business and the size of that business.
Yeah, so it's a great piece of business. It just describes what American Metals is all about. I mean, we launched this business in February of this year, and we're already starting to win all these other new contracts, such as this rail recycling car. So CSX and Indiana Rail have all these old coal cars that they're either taking offline and or they're replacing, and they needed somebody to recycle. Basically, they wanted to sell them off. And so we partnered with a group where we bought all these rail cars and committed for the next 3 years to buy these rail cars. And we literally are cutting them down into very small fragmented pieces to ship either to Nucor or one of the other electric arc furnaces, and basically be recycled into new steel. So we're taking a wasted product that they've historically honestly let rust on the rail lines and just sit there and park on idled facilities for years. Now we're actually starting to grab that business where we can just drive revenue. I mean, the beauty of it is it was sitting at one of our idle facilities. We had an old rail loadout facility we were doing nothing with, and we're able to utilize that now for effective revenue. We had to spend $0 to expand this business. And it'll be a couple $100,000 a year, but a couple $100,000 a year of pretty much pure cash flow is better than nothing. And if we can do that 5, 10, 15 times over, which we can, and we will, it's just a great another revenue line.
Yeah. Well, right now, looking at your balance sheet, what's your cash burn now, and are you going to have to do additional capital raises or anything?
At these levels, we do not want to raise equity at these levels.
Okay.
We have enough capital on our balance sheet and committed through our factoring company to bring the Perry County complex online. And Perry County itself will put the entire company at highly profitable. So we're not sitting here saying we need to raise capital today. We're actually in a pretty good spot. Our balance sheet has been cleaned up pretty significantly. Every quarter, we're making huge strides on just keeping our balance sheet as tight as we possibly can. And we have some new market tax credits on there that are not, we can buy out in 4 years for $1,000. That's sits at like $6 million today. So we have things on there like that we've been creative on how we've been able to utilize less dilutive financing structures. But other than that, I mean, it's a pretty clean structure. We have about $16 million of convertible debt with very friendly parties, mostly controlled by 3 people that are very close friends of ours. There's no variable rate structures. It's a pretty clean cap structure. It's a very clean cap structure.
So you don't have a bunch of warrants or something sitting out there?
The only warrants we have is about 3.6 million. That would bring in another right around 3.8 million of capital.
What's their strike price?
$1.05.
Oh, okay. So they could be doing that now if they wanted to. Okay.
Yeah, we've received. I mean, over the last few months, we got 100,000 in here and there.
Yeah. So you think after you get this Perry County thing up online, you should be operating cash flow positive and can fund future growth with that?
That's exactly the plan. So Perry County will fund bringing McCoy Elkhorn online, and then McCoy Elkhorn will fund bringing Wyoming County online. And each year we'll be putting more and more cash flow to the bottom line and just building up a cash balance that at the end of year 3, we can either distribute to our investors or we can reinvest and continue to expand the business from a creative perspective.
Yeah. Well, it sounds like you're in a great space. I love companies that have where management has skin in the game and have simple structures. It's the way to go. We just need to get past COVID-19 and hope there's not COVID-21, I guess.
That's correct. Hopefully the world's learning how to deal with it. I mean, it's been a crazy period, and hopefully everybody listening and on the phone haven't been too affected personally from it. But
yeah,
it looks like the economy's really bouncing back. We're seeing steel mills come back online quickly, which is huge for us. And they're trying. I mean, I think they're getting pretty nervous about where they're going to get their supply from, and which is a great problem to have for us.
Yeah. And what happens? It kind of drains the supply chain. And frankly, at the beginning of this, I was very, very worried about that.
Mm-hmm.
I was worried that, in the trucking industry, if there was widespread COVID within the trucking industry, then now you've got your, the guys that bring you this stuff
right.
are shut down. Then what do you do? Yeah.
I think the supply chains, I mean, and honestly, that's a huge thing for us too, right? I mean, we saw the weakness during COVID, which was supply chains. And that's logistics. And due to the need for logistics, the country is going to have to spend a lot more money to make it more efficient than what it was, because we saw the problem we all had, right?
Right.
And that's where, I mean, that's going to be a huge driver for future infrastructure. But we also saw a lot of the steel mills idle down during this and just sell inventory off their balance sheet. Now they're all of a sudden sitting here with very little inventory, and they're going to have to start ramping up production quickly. And that's going to, I mean, we're excited to fill that demand for them, and we can produce the quality that they need. And then when they call us up saying, hey, I need another 500,000 tons here, we'll just bring another mine online, and that's just more revenue for our investors.
Yeah. That's what people don't think about in these massive industries. Like the energy industry is the same way. When everything slows down, they talk about how much surplus we have in inventory and stuff like that. But when you live in a world that consumes energy and steel and minerals as much as this world does, once things ramp up, that excess inventory gets absorbed extremely fast.
Mm-hmm.
And you can go from a surplus to a shortage, and it doesn't take much of a shortage of food or a shortage of energy before everybody really starts panicking and paying up for it. So people need to remember that.
Absolutely.
Anyway, anything else you want to leave us with?
No, I want to say thank you so much for setting this up. Thanks everybody for listening. Dan and Sabrina, we don't take it lightly that you took a lot of effort and energy to put this together. Love to have more investors follow our story and follow what we're doing. We're really proud of it, but I can assure you that every day we focus on making our business better and doing it for all of our investors so we all succeed and win. I mean, we're built from a bunch of competitive guys. I mean, anything from military to Division I sports within our team here, and everybody wants to win. And we want to win the right way. We want to win when everybody wins. And we built that company from the start. We built it from the ground up, and we have a lot of room to continue to grow, and really appreciate the efforts you put forth to set this up, and really appreciate everybody taking a little bit of time to listen to what we're doing.
Okay, now we are recording this event, and we will be sending it out later today to about 250 of our members, and of course a lot of them will forward it to somebody. So in the past, we've actually gotten 3, 4, 5 times as many people watch the recorded event as attend. So it'll get you some nice exposure, and then we will follow the company. And I'll urge anybody, if you think of any more questions, please just post them to the EPG forum, and I will follow up. And if I can't answer it, I'll forward them on to the company. So thanks, Mark, for agreeing to do this.
Thanks for having me on.